The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to today's webinar. My name is Amanda Nichols from CCIQ and I'll be your facilitator for today. Joining us is Matt Richardson. He's the Senior Corporate Dealer at OFX. Thanks for joining us today, Matt.
Excellent. Thanks, Amanda. Excited to be on board.
Now, OFX, for those that don't know, is a partner with CCIQ. They're one of the world's leading global international payment specialists. And today's webinar is a second in a three-part series that we're doing with OFX. And through these webinars, they're sharing some key themes on driving global currency markets and key considerations for exporters when it comes to optimizing your payment routes. In today's webinar, Matt is going to explore the risk currency fluctuations pose and the products available to combat the volatility and protect your bottom line. Now, before we start, everyone online, if you have any questions for Matt at any stage during the webinar, just type them into the chat box that appears on the bottom right-hand corner of your screen. We'll collate these at the end and go through them. So now I'm going to hand over to Matt and he's going to take you through today's presentation.
Excellent. Thank you, Amanda, and thank you for the opportunity to speak to your members today and hopefully offer some insights into what we're watching at the moment and some solutions to those challenges that your members face in operating in this global economy. I guess as a quick starting point, we'll look to run through today's presentation, and I'll take you through a quick introduction of who we are, for who OFX is, for anyone that wasn't able to attend the first of the webinars. And then we'll go through a quick recap of market events and the current drivers that are dominating that global currency space and foreign exchange markets at this point in time. And we'll move on then to a brief explanation of really basically what risk is and how that can affect businesses like yourselves, and moving forward how we can offer solutions to help you stay on top of that currency volatility and the strategies as well that can help protect and fit in with your, I guess, approach and appetite for risk as well. So OFX was founded in 1998, so this is actually our 20th year of operations, and since that founding we've expanded pretty rapidly, and we now employ over 300 people across our offices in London, Sydney, San Francisco, Toronto, Hong Kong, New Zealand, and one that's not there now is Singapore, which was launched into this year as well. Australia remains the head office, and we were listed on the ASX in 2013 and have really seen some considerable and strong growth since then. You can see, looking at those slides there, just how far our reach is, and we are in fact the biggest non-banking financial payments provider in Australia at the moment. And we're hoping to push that across to our global markets as well as the business grows. Moving forward, I'd like to just recap, I guess, the current market drivers and the main points that are driving currency direction and influencing investors at this point in time. You would, of course, I would hope you'd all be aware of the current trade hostilities and geopolitics that have been the real focus of not just foreign exchange markets and the foreign exchange landscape of late, but wider global news feeds as well. And of particular importance for the value of the Australian dollar is those trade wars between the US and China. Australia has a heavy reliance on China as our major trading partner, and these recent trade hostilities have called into question China's growth outlook moving forward, as well as the global growth picture as well. And these tariffs are expected to impact the value of the Chinese yuan, and we've seen that depreciate significantly over the last few months since mid-April, and this trade war really kicked into gear. And that's had a significant impact on the value of the Australian dollar and meant that those gains that we saw at the start of the year and those levels around the 80-cent mark have well and truly been left behind, and it's really struggling now to make any significant upside against the US dollar, especially when we couple that with the US central bank being really the main central bank increasing their own interest rates. And when you compare that with the RBA last week, this week, came out and said that they expect the Australian Reserve Bank cash rate to remain on hold for the foreseeable future. The Reserve Bank in New Zealand left their rates on hold, and last week we saw the Bank of England as well, while raising rates, offer a caveat to that to suggest that they won't be raising rates again this year and perhaps only once next year. So in that environment, it's quite difficult to actually see investors moving away from the US dollar in the short term, which for those of you selling into US markets, I guess does bode well, as there is an opportunity to help maximise your returns there and perhaps repatriating those earnings back into Australian dollars. In saying that though, if you are selling into other markets, I guess there is a risk and a posed to what those returns and the volatility that we're now starting to see creep into the market as this shifting central bank landscape changes our expectations for currency values going forward. And like we've seen this morning, the New Zealand dollar has collapsed and the Australian dollar has pushed through year-to-date highs at the moment. So perhaps investors selling into the New Zealand market might now need to look at and consider their strategies going forward to protect those baseline Australian dollar earnings. Jumping ahead, and then I guess in that light and looking at what we can do to protect against that volatility, I think it's important that we underline exactly what is risk and what is foreign currency risk when considering it in your case as an exporter. Essentially, the simple, I guess, definition of risk can best be summarised as that impact of currency fluctuations on a business's financial performance or its bottom line financial position. And that risk can be exacerbated when you're dealing across multiple geographies and currencies. When we're talking about risk, I guess it's important as well to identify your aversion to risk, and that is critical when you look at the products that we're going to discuss later and developing a strategy to help you protect against the volatility that comes in dealing in the global market space. We find that our clients typically fall into one of three categories. They'll typically be risk averse, meaning they're really not open to taking in any fluctuations that come with foreign exchange markets and want to protect any volatility and movements in those exchange rates between perhaps a project being launched or a product being sold and the actual time of settlement and delivery on that particular export. There's others that have a moderate risk appetite, and they may look to employ a series of different products and hedging strategies so they can still, while protecting some level of bottom line, take advantage of upside moves, while the third category there have a relatively high tolerance to risk and are happy to ride the ebbs and flows of currency fluctuations and really don't take into account FX as part of their overall business model. I guess in moving forward as well, in monitoring volatility, it's important to understand where you fit in that risk aversion scale. And we can help to develop the tools and facilities that will allow you to protect according to that risk appetite level. I guess the key point in monitoring risk and protecting against it is monitoring volatility and fluctuations in exchange markets. And I guess the key tool or the best facility that I can suggest to anyone looking at entering into the global market space or currently involved in the current global market space is staying on top of current market events and driving forces, understanding what's fueling currency directions at that point in time and perhaps what is on the horizon that may affect the currency's value in the future is key to helping you to develop a strategy that protects your bottom line and ensures that you're not suffering exchange rates that might fall below your break-even point. For example, at the moment, perhaps a key highlighted event in the future is Brexit, and we've seen that come into the mind's eye again of markets this week after there was a suggestion that come March next year they will be forced to leave the EU without necessarily having generated or negotiated a specific trade deal, and that suggestion has forced markets to heavily revalue their expectations for the pound, and we've seen it slip below key support points this week and slipped below 130 against the US dollar, and which means the Australian dollar is pushed back above 57, and I guess it opens the door perhaps if there is further weakness for the pound for moves back towards that 60 pence handle. In identifying your own break-even points and implementing specific risk parameters around this, it allows us to then take a look at those events and ensure that we're employing the tools that alert you to any key market move that may help you to increase the return that you can get from your global operations, but at the same time ensure that you're not incurring losses that come from a sudden or a sharp movement, or a slow or gradual depreciation or appreciation over time. We'll now look to explore, some of the products that we offer that might fit into your risk appetite strategy, and we'll start with forward exchange contracts. This is perhaps a facility for those that are relatively risk adverse, as it lets you take out the impact of ongoing market movements and protect against any adverse shift towards the downside, locking in today's exchange rate for settlement at a future date. There's a number of key benefits to the forward exchange contract, and the primary one is that ability to lock in today's rate, take out any future fluctuations, and know that your bottom line return in Australian dollars is fixed. For example, if you were exporting a product into New Zealand and you wanted to ensure that after today's downward shift you weren't exposed to any further losses that may come over the coming months and throughout the early part of next year, you can take advantage of today's exchange rate, locking that in without really affecting your wider cash flow. A forward exchange contract allows you to lock in that rate without having to pay the upfront cost of the full position. At OFX, we would usually request a 5% deposit at point of entry, but there are solutions as well that allow you to obtain an unsecured credit limit and even avoid having to put any upfront cash to protect that position. They also offer you flexibility in terms of the time of delivery to your product. So obviously, in this case, your timeline of a particular project or the sale of a particular product can certainly fluctuate if a customer has to push back due to their own cash flow issues, or a project runs early and you want to be able to reconcile those earnings at an earlier date. The forward exchange contract gives you the function to be able to push forward or bring in that settlement date. And there, the main benefit as well is they're a relatively straightforward product to understand. You're locking in the rate. You know then that the market movements are out of the question going forward, and that you can protect that bottom line level. But of course, as with any financial product, there is always an opportunity cost and cons or shortfalls to that forward exchange contract. The main one there is that it doesn't really allow you to take advantage of any upside. So for example, you may lock into a particular exchange rate, but between now and then the value of the currency that you've sold with your customer is appreciated, and you could have enjoyed a higher Australian dollar return if you'd waited until the settlement date. That is the primary cost to the forward exchange contract, is the opportunity loss in between entry and settlement with the market moving higher. Of course, as well, there is a risk with the forward exchange contract that should you need to cancel out of a position because a particular contract falls through with your customer, then that can leave you exposed to that position. When you enter the forward exchange contract, you are entering into a binding contract to sell that currency and buy into the Australian dollar, or of course, if you're an importer, sell Australian dollars and buy the foreign currency. And if you have to cancel that contract, well, OFX as your provider would have to sell those funds back into the market, which, depending on how the market has moved within that timeline, can mean a profit or a loss, and it's important to consider your aversion to being able to cover that, and making sure when entering a forward exchange contract that you're really not doing that on a speculative position, but it's a firm position that you have and a firm contract or payment that you do need to settle to help eliminate that exposure or risk to a cancelled contract. The second product we'd like to go through today is perhaps more suited to someone that has a moderate appetite for risk and would like to, take advantage of any upside moves. And limit orders allow you to do that. It's a standing notice to lock in a trade when the market reaches a particular target rate. The foreign exchange market is the largest financial market in the world. It operates 24 hours a day, 5 days a week. So from 9 a.m. on Monday morning in New Zealand right until 5 p.m. on Friday afternoon in New York, the foreign exchange market is open. And obviously you can't be expected to be monitoring that market at all times. And the limit order gives you the facility to attract or or achieve a particular exchange rate that might be key to your baseline break-even points without having to look at those rates 24 hours a day, 5 days a week. It's essentially a standing order for OFX or your current provider to watch the market for you, and it's permission for us to purchase a particular amount of currency for you at a particular exchange rate. Obviously, with that comes, I guess, the risk that that order or that notice triggers at a point that you're not ready to settle. But the good thing about the limit order is it doesn't have to be settled on an immediate basis. You can then extend that position into a forward exchange contract to better fit your settlement date. The main risk to the limit order is while you're watching that upside, you may not have any protection on the low side. So it's important when entering into a strategy of employing the limit order to take advantage of any upward moves and try and catch that rate that means you're hitting your break-even point or your best return on your foreign currency exposures, that you have I guess a strategy in place to ensure that you're not allowing the market to move below a certain level and expose you to losses if it does move against you. So we'd always encourage our clients, if they are employing a limit order strategy, to also consider where their level is on the downside. And the beauty of the limit order is it can be cancelled at any point until triggered. So if you do have to take the market rate and hedge because it is moving against you, well, then there's really no cost to cancelling that order. Looking ahead to options, and this is perhaps a product to those optimists that might be expecting their exchange rate to move higher, but really don't want to eat into that bottom line level. And this allows you to lock in a specific exchange rate while at the same time affording you the flexibility to take advantage of any upward movements or cancel out of that actual delivery and settlement should a contract fall through. So it's not a binding order like the forward exchange contract. It's the option to purchase currency on a particular time of settlement. This allows you to take advantage, as we said, of any upward movements that you might see in the exchange rate, but locks in your baseline cost and the largest possible loss that you would see through the point of entry into the sale of a particular product and its actual settlement in 2, 3, 4 months' time or 2 weeks' time, whichever your term of delivery are. And the only issue, I guess, with the option, and there are various different options products, but today we're just focusing on a European option, which is what we offer here at OFX, is that settlement date is fixed. So unlike the forward exchange contract, you don't have the flexibility to be able to bring forward that settlement date. There is some solutions that we can help tailor if you would need to, or if you would like to extend that, but that involves rolling that into a different type of product. So if you come to the end of your fixed settlement date and you wish to exercise the option because the market rate has fallen below your protected level, well, you can then roll that into a forward contract, but that then becomes the binding product and you lose that ability to, I guess, cancel out of that at the time of settlement. And the other con, I guess, is that it can be costly. It does rely on the volatility in the market at the time, as well as a number of key factors, and those are being the strike price, so the rate that you want to protect, the size of the particular option that you're looking to hedge against, as well as the time to delivery. So essentially, if you're looking to protect against a settlement date within 12 months' time for a large amount, and you have a strike price that's well away from the current market rate, the cost of that premium is going to be quite high. But you can reduce that cost by reducing this overall size of the option and perhaps pairing that with a different strategy as well, like a forward exchange contract, or looking at spot deals or limit orders to take advantage of any other upside moves as you move along. The final product I'd like to go over is just the simple spot rate. And a spot rate is trading at the market rate on the day of delivery or settlement. This really just allows you to be flexible in delivering your immediate transfer requirements. It's relatively straightforward. You're just looking at the rate of delivery on time on the day of your payment being due. But I guess it doesn't protect against any moves in the currency market between when you might enter a contract and when you go forward with its settlement. So for example, some of our clients will use a spot rate scenario to spread that risk over time, and by paying out those deals over time, you do see that perhaps you can average out your overall foreign exchange cost. Sometimes that would work in your favor, like those at the moment selling US dollars and buying Australian dollars, but equally it can work against you for those perhaps selling pounds, New Zealand dollars or euros back into Australian dollars as well. So it's important to consider, if you are just looking at simply a spot rate strategy, that you build in as well those thresholds for movement and have flexibility in your own contracts that you might have with your customers. Of course, a hedging strategy doesn't have to involve just simply these products. It can be in the means of your actual setup of your business and the way you work with your customers as well. A lot of our clients will actually deal on the spot rate and have caveats within the contracts with their customer base to say, well, if the exchange rate moves beyond this set parameter, while we've agreed a deal to be processed at, say, 75 cents against the US dollar, if we see the US dollar fall throughout the time of us agreeing this contract and us delivering the product to, and the Australian dollar improves to 76 cents, well, then we're going to have to reevaluate that and your costs may go up. So there's certainly tools that you can employ outside of just simply these in your everyday operations with your clients as well that can help to protect you against your foreign exchange risk. And the important thing is looking at these tools as perhaps an addendum to that overall strategy and an addition that will help you to ensure that you're maximizing your return in your foreign exchange. We are expecting to see an increase in volatility across foreign exchange markets as we move through the rest of this year into 2019 and 2020, as the period of really, I guess, easy money that we've seen central banks around the world pumping into the economy starts to change. And of course, these geopolitical issues that we touched on at the beginning as well. So I'd encourage you all going forward, if you are selling into an overseas market, to certainly look at these different hedging tools and ways around protecting that bottom line, as we expect to see the value of the Australian dollar fluctuate quite significantly leading into next year. I'd now like to, I guess, open the floor up to any questions that you might have, and hopefully if you have any queries going forward after today, you can reach out to us on this link below, and we'd be more than happy to help facilitate those and your needs going forward.
Excellent. Thank you very much, Matt. We have quite a few questions that have come through, so we'll get through to these now. First question, I've started investing into cryptocurrency. Can OFX help me with this?
Unfortunately, that's one thing that we can't help with at the moment. Cryptocurrencies, being an unregulated market, the risk of being politically incorrect are unfortunately a highly used tool for anyone looking at money laundering and counterterrorism financing, and our rules and regulations that we have to comply with not only our local regulators here in Australia but globally mean that we've taken I guess an internal compliance decision to avoid any payments that might link to cryptocurrencies. Unfortunately, most of the time people are doing the right thing, but that unregulated nature of that market just means there is that increased risk there, and it's not something that OFX is unfortunately prepared to involve in.
No, that's fine. Thanks for clarifying that. Another one, why would I use a foreign exchange company over a bank?
Yeah, that's a great question. Thank you, Amanda. We have seen an increase in the number of non-bank providers entering the Australian market recently, and of course globally as well. And the reason for that is simply an appetite. The banks have typically not delivered a product or a solution for middling level customers. So that is those clients that aren't big global value chain companies, and companies like OFX can offer you a better solution, a more tailored approach to your foreign exchange risks and a better exchange rate. You can essentially leverage OFX's overall volumes and its relationships with its banking counterparties to command a better exchange rate, and I guess have a more personal touch with your day-to-day foreign exchange needs. Our focus is solely on foreign exchange, so you know that there's no bias with us selling you a particular rate here with a view to perhaps try and maximize a return from you in another area like a trade financing facility or a business loan. So the main benefit of our facility is that tailored and professional approach to your needs and solely focusing on just your FX requirements.
And Matt, how long will a transfer take?
That's another good question. It does depend, I guess, on the currency corridor that you're looking at. We employ banking relationships across the globe, and we have accounts within most G10 currency corridors. So you're looking at banking with Bank of New York, domestic accounts in the US. We bank with Barclays in the UK and Europe. We have local accounts in New Zealand, Hong Kong, Singapore, Canada, everywhere that we've got offices, and as well as into Asian markets like India and as well. We have local bank accounts. So that helps us to speed up the time delivery. Typically, we'd see a transfer of a major currency pair taking 1 to 2 business days as a general rule, but there are moves as well in the future as we look at this, the new payment platform here in Australia, and we shift away to a more digital approach to currencies rather than the old analog systems that have been employed in the past, that we are hoping to be able to offer same-day settlement in the future. But we'd always encourage our clients to at least allow 1 to 2 days as a normal settlement rule.
And just following on to a question about transfers, do you have a minimum or maximum transfer limit?
For a normal spot deal, no, there's no minimum or maximum transfer limit. For those particular hedging products, there is some minimum sizes. Typically with the forward exchange contract limit order and the option, we put in a minimum transfer size of 30,000 if it is a one-off. But of course, for our corporate clients, we do try and look at the bigger picture as well, and take your into account your needs as a whole and your overall currency exposure. So if a particular contract is part of an overall project where the exposure is beyond that, then certainly we've got the flexibility to be able to move below those minimums and ensure we're not constrained by those and can enter into a product that suits your particular needs in that instance.
Thanks, Nat. Now, with increasing online fraud, and I think this is a very good question, how do I recognise the warning signs of transfer fraud?
Yes, absolutely. It's certainly been something that's very important to us here, and there are a number of, I guess, key things that we can help to look out for. Obviously, in the global marketplace with language barriers, etc., it can be sometimes difficult to identify if you're dealing with a person that's legitimate or not. We'd always encourage our customers to either, if they can't meet face-to-face, or at least have a verbal conversation with someone and identify those contact details outside of an email chain that may have been started with a particular person. And if there's any change or request to amend payment instructions or receiving details, then to question that back against an independent chain of inquiry, and make sure that you're looking at all the processes along that, I guess, communication channel, and ensuring that even if it's as simple as just checking that the email address is the same as that used in your initial correspondence, and of course going on forums as well, and checking against those. There's also a number of different government tools as well that can help to identify fraud. There's ACORN, which is the Australian Cybercrime Unit, as well as other government departments as well that are looking to combat these fraudulent activities. At OFX as well, we have a transaction monitoring team that's dedicated to identifying these things, and obviously we've had parameters built in to our platforms that hope to identify these issues before it's too late and funds are settled. But I guess it's always important to do your due diligence on any new supplier or any new customer that you might be dealing with before entering into actual settlement or delivery of a product.
Yeah, it's very, very scary. Thanks, Matt. Now we'll have one more question. Now this person has said that they've been stung by hidden costs associated with international transfers, and they just want to know if you can give any tips on how they can spot this for next time, just to make sure that the quote matches the final bill and there's no surprises.
Yeah, absolutely. The first thing is, I guess, understanding exactly the product that you're looking at entering into. So if you are employing a hedging tool like a forward exchange contract, it's understanding exactly how that works. To give you an example, the forward exchange contract, as we said before, takes today's exchange rate, but it does adjust that for interest differences between the two central banks for the currencies involved. So what a lot of clients don't understand is that if you're selling US dollars and buying Australian dollars, with US interest rates now above those in the US, above those, sorry, in Australia, there's actually a slight depreciation in the exchange rate from when compared against the spot rate, and if you extend that beyond its normal settlement date. So it's understanding how those interest points might play an effect on the value of your exchange rate over the life of the contract, as well as comparing the rate that you achieve against the current market price. So we encourage you to look at our market price as well as the customer rate that you offer, so you can see with transparency exactly what those margins are and understand that this is your exchange rate at this point in time. And obviously, I guess those hidden costs come typically from possible bank fees that may be charged between intermediaries along the way. The good thing about our domestic account bases in most currency pairs is that the international transfer from the US to Australia, New Zealand to Australia, wherever that channel is eliminated. And the cost of a domestic transfer is typically free. So we're immediately eliminating those pesky sort of $20, $30 charges that the banks employ just to facilitate that transfer. I hope that answers your question.
Great. Thanks, Matt. Thank you for presenting today and going through all those questions for us. Also, thank you for everyone who has joined us for today's session. We will aim to get out to you this afternoon an email with a copy of the presentation slides and the recording, as well as some other contact details for OFX. Also, make sure you stay tuned. We'll be launching the final webinar in this series, which will be discussing getting your business ready for export. So keep your eyes out for our events and webinar newsletters to be promoting that one. Thanks again, Matt. Thanks for everyone for joining us, and enjoy the rest of your day. Thank you.